Let's take us to our talk of the tape. Is it the all clear that we've been waiting for? Let's bring in Avery Sheffield, VantageRock co-founder, CIO, and portfolio manager, back with us at Post 9. Nice to see you again.
Great to be here.
How would you answer that? Is this all clear?
Nothing's ever all clear, but I think that this is a materially positive outcome. And I think 90 days from now, both the United States and China have seen the very negative consequences of decoupling. And we're probably unlikely to have tariffs higher from here unless there's some geopolitical event that, I don't foresee. So, yeah, I think that things are definitely much better, and we're getting back to closer to a place than before the tariffs, because I think 30% tariffs from China can be absorbed by both economies, as well as the 10% floor elsewhere in the world.
So if not full all clear, do you feel like it's enough of a lifting of the fog for both investors and companies that we can take at least the worst case scenarios off the table?
Absolutely. Yes, definitely. Because I think the fact that we've seen Trump react to how dire the consequences could be from tariffs that effectively stop trade, I think that's why we're unlikely to go back, and we're only going to have tariffs at a level that can be absorbed and digested.
Okay, so what do I do? If I'm an investor now and I was somewhat paralyzed by the unknown, I thought maybe there would be an eventual good outcome to all this, but I still wasn't certain. I'm worried about a recession. The Fed tells me they're not going to cut anytime soon. So now that I feel like that's changed, what do I do?
Yes. Well, I think that you can lean, you maybe have been over the past few weeks, but you can lean into less expensive cyclicals, right? Because we're in a backdrop that is going to be okay. Like, I don't think this is the all clear that the economy is going to go, gangbusters, right? But we still do have about a 3% increase in the fiscal deficit, right? So the fiscal is still expansionary. It has been all year. Mm-hmm. You remove this, and, that's a pretty benign, economic backdrop. You do have the counter of interest rates higher, and I think it's going to be hard for Trump to accomplish his really low interest rates with the deficit where it is and the expansion, as well as tariffs coming to a more manageable level. So you have the headwind of rates, but you have the rest of it's positive, and so that to us means that stocks that are exposed to the economy, that are reasonably priced, so valuation hasn't gotten extreme. Mm-hmm. Can probably outperform in this type of environment. I
mean, you could say, well, perhaps this frees the Fed up to actually cut, right? Because you've removed the tariff-induced inflation out of the picture. They were poised to cut anyway before all of this happened, and then they had to say, well, now we might be in conflict with our two mandates because we thought we were in pretty good shape, but now we've got an inflation issue potentially to think about. How about that? Is that too far-fetched?
Yeah, I think it is. I think the 10-year is telling us that there's no reason to cut, right? The reason you cut is because the economy is really slowing, and the economy is holding up. I mean, all of us have been worried about the economy slowing, and we do have, at the low end of credit, you are starting to see some signs of stress, but they're pretty minor. We're still at full employment. Businesses are going to be more optimistic about spending. And so I think the Fed would be very concerned about reliving what happened last September, right? So everyone in the summer thought, like, oh, the Fed's going to cut rates. All rates are going to come down. That's going to be great for the economy. But the problem is the Fed cuts rates too early. What happens is the 10-year blows out. That's not great for the housing market. That's not great for long-term investing. So I think the Fed's still going to be at a place where they're going to stay put because they want to save that fuel for when they really need it. And they definitely don't want the 10-year to be going higher.
Unless they think they're just too restrictive now in an all things being equal environment.
But
right?
The 10-year would go even higher. I think because it's stimulative, right? Because if you cut when you don't need to cut, you're basically just freeing up money for the economy. I mean, that's definitely my concern. And I think the markets are telling you this, right? The rates went up, not down, with tariffs coming down because it's bullish for economic activity. Mm-hmm. It unleashes the money supply.
What about the idea that, as all this was unfolding, you had a lot of money going into other parts of the world? Does that eliminate that? Are we back to talking about U.S. exceptionalism again today?
I don't know that we're back to talking about full U.S. exceptionalism, but I do think that you won't see the same fear factor of investing in the United States that you did before. But I think that this whole event has led people to pay attention to the opportunities that exist elsewhere in the world, right? So already people were starting to pay attention to Europe. They're paying more attention to Europe. They're paying more attention to other economies. And there are a lot of developing markets that are levered to China trade with the rest of the world, including the United States. So I think you continue to see money move into those markets, but also people less fearful of the United States.